If the financial system were to collapse, money in the bank wouldn't exist in the way we think of it today. For example, a $92 billion balance sheet could shrink to just $1 billion because the entire system is built on debt and paper assets having value. If that debt becomes insolvent, everything would unravel. Now, if you took the global financial system as $900 trillion in purchasing power and divided it by Bitcoin's fixed supply of 21 million coins, you would get an astronomical figure, about $43 million per Bitcoin. And that's before accounting for lost coins, which would push that value even higher. It's important to realize that in 5 years, the global financial system's $900 trillion balance sheet likely won't be the same size. Debt currently stands at around $400 trillion, but if these figures remain static, the system would collapse. This highlights the fragility of the current monetary system and the potential role of Bitcoin as an alternative store of value if such a collapse were to occur.
If the financial system were to collapse, the traditional concept of money in the bank would be drastically altered. For instance, a $92 billion balance sheet could potentially shrink to just $1 billion because the entire system relies on the value of debt and paper assets. If that debt becomes insolvent, the entire structure could collapse. Consider the current global financial system, which has a balance sheet of around $900 trillion in purchasing power. If we divided this amount by Bitcoin's fixed supply of 21 million coins, each Bitcoin would theoretically be valued at around $43 million. This value doesn't even account for lost coins, which would push the estimated value per Bitcoin even higher. It's crucial to understand that this $900 trillion figure won't necessarily hold over the next 5 years. The global debt, currently around $400 trillion, is unlikely to remain static. If the balance sheet and debt levels continue on their current trajectory without adjustment, the entire system is at risk of collapse. This scenario underscores the fragility of the existing financial system and suggests that Bitcoin, with its fixed supply and decentralized nature, could serve as a valuable alternative store of value. In the event of a significant financial upheaval, Bitcoin's role could become even more pronounced as a hedge against the instability of traditional financial structures.
Subscribe our channel and press the bell button to get our video notification. And like the video.
I'd recognize that Bitcoin's current Layer 1 system isn't fully compatible with the existing financial framework. To bridge this gap, I would focus on integrating Bitcoin with the US dollar, effectively tying Layer 1 to traditional fiat currencies. This would help align Bitcoin's foundational layer with the established monetary system, making it more palatable to mainstream financial institutions. Next, I work on developing and optimizing Layer 2 solutions. By focusing on Layer 2, which includes technologies like the Lightning Network, I could enhance Bitcoin's scalability and usability, making it more practical for everyday transactions and further integrating it into the financial ecosystem. With this strategic approach, I could facilitate a gradual transition from traditional assets like gold and the petrodollar system to Bitcoin. By extending and adapting the existing financial game for another 20 years, I aim to create a smoother and more sustainable integration of Bitcoin into the global financial system. This would position Bitcoin not just as an alternative asset, but as a central component of the evolving monetary landscape.
First, I'd acknowledge that Bitcoin's current Layer 1 infrastructure isn't fully compatible with the existing financial system. To overcome this, I would focus on ensuring that Bitcoin's foundational Layer 1 is closely tied to the US dollar. This would involve creating mechanisms to anchor Bitcoin to fiat currencies, making it easier for mainstream financial institutions and regulatory bodies to accept and integrate Bitcoin into their frameworks. Once Layer 1 is aligned, I turn my attention to Layer 2 solutions. This involves enhancing Bitcoin's scalability and functionality through technologies like the Lightning Network. By improving Layer 2, Bitcoin can handle a higher volume of transactions more efficiently, making it practical for everyday use and broader adoption. This step is crucial for integrating Bitcoin into the financial system on a more functional level. With these adjustments in place, the transition from traditional assets, such as gold and the petrodollar system, to Bitcoin could be more feasible. I'd aim to leverage these improvements to gradually shift the financial landscape, extending the current financial game for another 20 years or so. This strategic integration would position Bitcoin not merely as an alternative asset, but as a central player in the evolving monetary system, smoothing the path for its acceptance and integration into global finance.
The true rate of return implied by Bitcoin is around 45%. If you're investing with the goal of exceeding this 45% return, the only viable way to do so is by creating a Bitcoin-focused company that increases your Bitcoin holdings on its balance sheet by generating real value. This approach leverages Bitcoin's appreciation while actively building value within the company. For me, this is a clear opportunity, and I am surprised that more people down at T recognize it. The strategy involves using Bitcoin as a core asset and driving growth through operational excellence and value creation. By doing so, you can potentially achieve returns beyond the inherent 45% that Bitcoin itself implies. This approach is distinct from the strategy employed by figures like Michael Saylor. Saylor's playbook focuses on accumulating Bitcoin as a hedge against inflation and using it as a strategic asset on his company's balance sheet. While there are similarities, his strategy is more about leveraging Bitcoin as a store of value and financial strategy rather than creating a business model centered around increasing Bitcoin holdings through operational value creation.
The true rate of return implied by Bitcoin stands at about 45%. If you're aiming to surpass this 45% return, the most effective strategy is to establish a Bitcoin-focused company that enhances its Bitcoin holdings on the balance sheet by generating substantial value. This approach leverages Bitcoin's potential appreciation while actively creating value through business operations. To beat the 45% implied return, you would need to not just invest in Bitcoin, but also develop a business model that grows Bitcoin assets through innovative and value-driven activities. This means building a company that increases its Bitcoin reserves as part of its core strategy, ultimately aiming for returns that exceed Bitcoin's natural appreciation rate. I find it surprising that more people don't see the potential in this approach. It's a clear and compelling strategy to use Bitcoin as a central asset and drive growth by adding value through your business operations. This method aligns with the idea of achieving returns beyond the inherent 45% that Bitcoin offers on its own. This strategy is distinct from what individuals like Michael Saylor are doing. Saylor's approach focuses on accumulating Bitcoin primarily as a hedge against inflation and as a strategic asset on his company's balance sheet. While there are some parallels, his strategy is more about positioning Bitcoin as a store of value and a financial safeguard, rather than creating a business that grows Bitcoin holdings through operational excellence. His playbook emphasizes Bitcoin's role in financial strategy, whereas the approach I am discussing centers on leveraging Bitcoin as part of an active value creation business model.
Subscribe our channel and press the bell button to get our video notification. And like the video.